The biggest financial reset in modern history is already underway, and almost nobody is paying attention. While everyone's distracted by crypto, hype, inflation, and politics, the real shift is happening quietly. Banks, asset managers, and central banks are rewriting the rules of ownership itself using blockchain. It's called tokenization, and it sounds like innovation. Faster settlement, fractional ownership, more efficient markets. But beneath the buzzwords lies a deeper reality. In this video, we'll break down what's really happening behind the scenes, how real-world assets like real estate, bonds, and even your money are being turned into programmable code, and why that should be a concern to everyone. Who controls the code controls the asset. If you're not watching closely, your financial freedom could disappear without warning, without debate, and without your consent. Tokenization is the process of taking real-world assets and converting them into digital records stored on a blockchain. These records represent ownership in physical things like property, shares, or government debt. They can be bought, sold, and transferred in seconds rather than days. The token itself is not the asset. It is a claim, often managed by a custodian or institution. This creates a layer of abstraction. You may not directly own the asset. You may own a programmable promise enforced by code and governed by private systems. This poses real questions about what legal rights you really hold when something goes wrong. For example, in the case of home or land ownership, tokenization could mean holding a digital token rather than a traditional deed. That token might represent a conditional claim governed by platform rules rather than full legal title. Your ability to live in, sell, or use your property could be controlled or restricted by automated code, subject to surveillance, remote enforcement, or compliance triggers outside your control. In this model, ownership becomes access dependent, not absolute, and legal protection is replaced by programmable permissions. BlackRock has launched a tokenized money market fund. Investors receive tokens that represent their share in the fund. Transactions settle instantly and are recorded on a digital ledger. The underlying investment strategy is traditional. What changes is the speed, control, and data visibility. Meanwhile, JP Morgan has built a platform called Onyx. It is already processing real-world lending and payments using tokenized assets. These are private systems that only approved participants can use. They do not run on public networks. They operate under the direct control of the institutions that built them. This is not open finance. This is programmable infrastructure owned by large players. Singapore's central bank has launched Project Guardian in partnership with global banks. It explores how tokenized bonds, digital deposits, and smart contracts can work in a compliant environment. Transactions are executed with full transparency, no paperwork, and near instant settlement. This is presented as efficiency. It is also automation of enforcement. Conditions are built into the asset itself. Payments, ownership, and regulatory checks happen automatically. Once rules are coded into the token, they cannot be bypassed. They are not interpreted by courts or reviewed by humans. They are executed by machines. Now, the benefits are easy to see. Trades can settle instantly, markets can stay open around the clock, expensive assets can be broken into small portions, smart contracts can automate everything from dividend payments to regulatory reporting, costs drop, delays disappear, manual processes are removed. But efficiency here is not neutral. These systems are programmable by design. If a token represents ownership and that token can be frozen or restricted, so can your access to the asset. Compliance, censorship, and enforcement can all happen at the infrastructure level before anyone has a chance to question it. Because tokens represent ownership in a programmable form, your ability to hold, use, or transfer your assets depends on the rules set in code and the permission of those who operate the blockchain. Ownership can be revoked or limited remotely without warning. You may find your access restricted based on conditions you did not agree to or cannot change. This is a fundamental shift. Asset ownership becomes conditional, subject to automated rules and gatekeepers. The control that was once exercised through courts or contracts now happens through code. That means who controls the code controls your access to your own wealth. Smart contracts are self-executing digital agreements. They carry out instructions when conditions are met. A payment can be made the moment a bond matures. Ownership can be transferred automatically when a price is received. These contracts operate without human input. They follow rules exactly as written. The blockchain acts as a shared ledger. It records who owns what. It cannot be edited without consensus from the system. This creates trust in the record. But when the system is owned and operated by a private group of institutions, trust is based on access, not openness. Public systems like Bitcoin are permissionless. The tokenized finance being built by banks is permissioned. Only approved parties can use it. You do not get to opt in. You're invited if you meet the criteria. This is not decentralization. It is a more efficient form of centralized control. To integrate these systems into existing finance, banks use global standards for financial messaging. At the same time, central banks are preparing digital versions of national currencies. These CBDC, central bank digital currencies, combined with tokenized assets, create a system where settlement is instant and every step in every transaction can be automatically monitored and enforced. The enforcement of taxation, regulation, and compliance becomes automatic. There's no human discretion, no appeals process. Rules are coded into the assets and executed in real time. This enables continuous surveillance and control of financial activity at a scale and speed never seen before. The promise of tokenization is to remove middlemen and democratize finance. In reality, it replaces many intermediaries with a handful of large institutions that control the private blockchains and platforms. The system is permissioned and gated. Access is controlled behind the scenes. It's not open to all. This creates a financial system that is more efficient, but also more centralized. Power is concentrated in fewer hands. Ownership becomes conditional on meeting rules set by institutions rather than supposed market forces. Efficiency does not guarantee freedom or inclusion. It may instead enable greater exclusion and control. Tokenization won't require your approval. It is being built by the institutions that already control markets. The shift will not happen through headlines or political campaigns. It will arrive through updated bank platforms, automated settlement systems, and redesigned legal definitions of ownership. Once it is in place, the rules will be embedded in the assets themselves. Markets will function without human discretion. Your financial rights will be defined by code and enforced automatically. In a recent interview, Augustin Carstens, the now former general manager of the BIS, compared money's evolution to that of the phone to emphasize the need for money to become more digital, accessible, fast, and integrated into everyday life, like smartphones transform communication and services. He envisions money as seamless, instant, and multifunctional, enabling new financial tools and convenience. But this vision masks deeper reality, of course. The same institutions that built the old system are designing the new one with even more control embedded at the infrastructure level. The shift to digital money is not about empowerment. It is about surveillance, enforcement, and programmable access controlled by private actors and central banks. This is why there is no public discussion over what is taking place. This is not a disruption, it is a reset. The people most affected will be those not paying attention to how fast this is happening. The true beneficiaries of asset tokenization are large financial institutions, central banks, and tech infrastructure providers. Firms like BlackRock and JP Morgan gain control over issuance, custody, and settlement on private blockchains. Central banks get real-time visibility, programmable enforcement, and tighter control over monetary flows. Tech providers profit from running the infrastructure and setting the rules. Private capital benefits from new liquidity and global access, while governments gain tools for direct behavioral control. Meanwhile, everyday users are left with programmable ownership, limited autonomy, and no real say in the rules, despite the promise of innovation and inclusion. Most ordinary people will lose control over their assets, as programmable tokens can limit how and when money is used, with market access dictated by platform rules rather than true ownership. Small investors may gain exposure to tokenized assets, but will remain subject to institutional control, fees, and restrictions. Meanwhile, those without digital IDs or banking access, often the unbanked and off-grid, will be excluded entirely, as this new system leaves no room for cash or informal transactions. The mainstream counter-argument is that it will promote financial inclusion. But the time-trusted lessons are obvious. Hard assets are your last line of defense. Use decentralized tools, not institutional ones. For some, Bitcoin and permissionless crypto are escape valves, but only if you self-custody. Keep a foot in the real economy. Use cash while you still can. Build local networks. Structure strategically. It's also possible trusts, offshore entities, and dual citizenships can slow down automated compliance. Think legally, not just tactically. Stay ahead of the narrative, learn how the infrastructure works, watch what BIS, IMF, and central banks are actually building, not what they're saying. Efficiency is, of course, bait. Control is the hook. Tokenization is not about inclusion or innovation, it's about programmable ownership, automated enforcement, and institutional dominance. Default is not destiny, so we may not stop the system, but you can minimize exposure by time and build parallel options. Now, I hope this has been useful. Thanks so much for watching. Do have a look at the rest of the playlist if you haven't done so before, and I look forward to seeing you next time. Bye-bye.